Have you ever wondered why most of the fintech startups fail while only some of them scale up? It is not apart from having a very strong business model. This is because these organizations obsess over the right KPIs that exactly helps them understand when to scale up and when to pull back. So in today's video, I'll be breaking down the top 10 fintech KPIs that drive growth, efficiency, and investor confidence. If you are working in finance or FP&A, these are the KPIs or metrics that you must understand. Before we jump into the KPIs, let us quickly first understand what exactly is a fintech company and why measuring performance here is so different from a traditional finance organization. Fintech simply means financial technology. These are companies that use software, automation, and data to deliver financial services. Now, fintech is not just one kind of business, it's an entire ecosystem. So, let's quickly understand the five major categories of fintech companies and how each one operates. On a quick side note, if you are serious about growing your career in FP&A, then do check out our Certified Global FP&A Professional Program. CGFPA is a 6-month accredited certification in FP&A designed to help you become real business partners. If that sounds something you would be interested in, links are in the description. Also, there are a bunch of free resources that you can download on FP&A, including books and free courses. You will find all the links in the description. The first type of fintech companies are the payment processors. These are companies that power online and offline payments. For example, companies like Stripe and Razorpay, they help businesses accept card payments, digital wallets, or UPI seamlessly. Their revenue usually comes from charging a very small fee, often less than 1%, on every transaction process. The faster and more reliable their system, the higher is their transaction volumes and revenues. The second type of fintech companies are the digital wallets. These are companies like Paytm and PhonePe, where the users store money digitally and use it to pay for everyday expenses, from groceries to cab rides. These apps thrive on microtransactions and user engagement. They earn from merchant commissions, bill payment fees, and sometimes interest on idle wallet balances. The third type is the P2P lenders such as Lending Club. They connect individual borrowers directly with investors, removing the traditional bank in between. The platform earns through service fees on loans issued or repaid. Their biggest focus is managing risk and maintaining low default rates. Then comes the investment and the wealth management apps like Zerodha, Grow, or Robinhood. They give retail investors access to stocks, mutual funds, crypto, and ETFs with in just a few clicks. Their revenue models include transaction fees, subscription plans, or margins on cash balances. Here, the engagement and trust is everything because each trade directly reflects the user confidence. And finally, we have the neobanks, or also known as fully digital banks with no physical branches. These are banks like Neobank in the UAE, or Jupiter or Neobank in India, or Chime in the US. They offer traditional banking services like saving accounts, debit cards, payments, and even loans entirely through mobile applications. They make money through interchange fees, lending spreads, or subscription models. Their superpower is their great user experience, instant onboarding, and personalized insights. So, whether you are enabling payments, managing money, lending, or banking, every fintech company relies on core set of metrics that reveal performance, scalability, and profitability. Let's now dive into the top 10 fintech KPIs that truly define their success. Starting with the king of monetization, the first fintech KPI is the average revenue per user. Average revenue per user is how much revenue each active user generates. Your ARPU tells you how well you are monetizing your user base through transaction fees, subscription, interest spreads, or FX markups. For example, if you earn $10 million from 1 million users, your average revenue per user is $10. A 10% lift in average revenue per user is often worth more than 10% new users. For FP&A teams, they use ARPU to forecast revenue growth, model pricing changes, and segment users by profitability. Now, revenue is great, but the revenue solely depends on how smoothly the operation runs. That's where our next KPI comes in. FinTech KPI number two is payment success rate. This one is huge for any payments or wallet based fintech company. Payment success rate measures how many transactions go through successfully. Each failed payment is lost revenue and poor user experience. Investors and FP&A teams track this very closely to monitor the fintech companies' infrastructure reliability. Even a 1% improvement here can mean millions in extra monthly gross transaction value. FP&A models this to project revenue leakage and technology return on investments. If you are in a lending company, then the biggest risk isn't the failed payments, it is the failed repayments. FinTech KPI number 3 is the loan default rate. For lending based fintech startups, your make or break metric is the loan default rate. It measures the credit risk and the quality of your underwriting process. Understand with the help of an example. If the company disburses $10 million of debt, and if $300,000 out of that goes bad, your default rate is 3%. For consumer lending companies, that is borderline risky. For FP&A teams, a small rise in the default rate can wipe out the entire profitability. Hence, the finance teams focus on building modeling scenarios like how a 2% increase impacts cash flow, provisioning, and the regulatory capital. Whether you are in lending or transacting, what really matters is, are your existing customers spending more over time? That's where our next KPI comes in, the net revenue retention. Your NRR, or the net retention rate, shows how much recurring revenue you retain from existing customers after upgrades, downgrades, and churn. Anything above 100% means that your customer base is growing organically, even without new customer signups. Let's understand this with the help of an example. Say if your starting base is $1 million in MRR, or monthly recurring revenue, and if you lose $50,000, expand by $150,000, then your NRR, or your net retention rate, is 110%. That is a best in class fintech retention rate. FP&A teams use this metric in investor decks to forecast and show product stickiness and revenue resilience. Now, retention is revenue stability, but let's zoom out and understand how big is your overall flow of money. That is where the next fintech KPI comes in, the gross transaction value, or the GTV. The gross transaction volume is the total value of all the transactions processed on your platform. It is the foundation of your business model. Payment wallets or effect fintech often earn revenue as a very small percentage of the gross transaction volume. GTV forecasts help predict revenue, assess growth momentum, and model seasonality. Now, GTV gives you the volumes, but what percentage of that actually becomes revenue? That is your next fintech KPI, the take rate. The take rate measures how much revenue you earn for every dollar of transaction volume processed. A higher take rate usually means better monetization per transaction, but if you go too high, then your customers may switch to the competition. Let's understand this with the help of an example. For a $5 million revenue on a $500 million gross transaction volume, that is a 1% take rate. Even very small shifts here can massively change your top line. FP&A teams use take rate to do sensitivity analysis and do modeling to optimize pricing without hurting the volumes. What if the customers start leaving? That's when your next fintech KPI comes in, and that is the customer churn. The churn rate measures how many users stop using your product within a given period. Now, acquiring a new fintech user can cost 5 times more than retaining an existing one. For example, if there are 5,000 users that leave your platform out of 100,000, you have a 5% churn rate. For fintech company, anything under 3% is usually healthy. FP&A teams use the churn rate to model retention cohorts and then predict the lifetime value of the customers. Now, next, let us measure the real engagement and not just the signups, but how many users are actually truly active. This KPI tracks how many users perform at least one transaction or log in within a specific period. Inactive accounts don't generate revenues. For fintech companies, the daily and the monthly users show the true engagement. For example, if 80,000 users out of the 100,000 registered users are active, that's a 80% active rate. FP&A teams model active user trends to forecast transaction volumes. This KPI shows costs to process each transaction, including the payment gateway fees, infrastructure, and support. In high value fintech companies, even a few cents saved per transaction can mean millions of dollars in annual savings. FP&A teams use this to monitor efficiency, model unit economics, and optimize the infrastructure investments. And finally, we come to the fintech company's reality check, which is the burn rate or the cash runway. The burn rate shows how much cash your company spends each month, and the runway shows how long your cash will last. This is the most important survival metric, especially for early stage fintech companies. For example, if your burn is $200,000 a month and if you have $1.2 million in your bank account, you have a 6 months runway. FP&A teams use this in board reporting, investor updates, and scenario planning. It tells you how many months you can sustain before needing new capital. Now let's bring everything together. So there you have it, the top 10 fintech KPIs. The average revenue per user and the take rate measures monetization. The gross transaction value and payment success rate track scale and performance. The NRR and churn reveal retention. The loan default rate controls risk. The cost per transaction shows efficiency, and the burn rate and runway protects your future. Together, these 10 KPIs tells is scaling sustainably or burning cash in silence. If you found this video helpful, then do smash that like button and subscribe for more FP&A videos. And tell me in the comments below which other industry KPIs would you like me to cover next. Also, check out a bunch of free courses, resources, and books. All the links are in the description. Thank you so much for watching, and I will see you in the next video.